Okay, I will start by sharing my screen.
Sorry, before you do, can I just say there's some background noise? People are struggling with the noise. Just wondering if everybody could mute. If not speaking, that would be great. Thank you. Is everybody hearing okay now?
Yeah, that sounds.
Okay, when you're ready then, Kevin, thank you.
Okay, yeah, well, thank you very much for inviting me along. So I'm just moving a few things around on my screen so I can see my notes. So, as Claire says, my name's Kevin Graham. I'm one of the specialist financial advisors working at Wesleyan. So, been asked to come along and sort of help you improve your knowledge of the NHS pension scheme. I've got a presentation that will last around about 30 minutes. And then lots of opportunities to take questions at the end. As Claire says, either hang on to your questions, ask me at the end, or pop them in the chat, and we'll cover them off towards the end as well. So, right. Okay, so let's just start by telling you a little bit about who we are at Wesleyan. So Wesleyan Insurance Society has been around for over 180 years. This means we've got the financial strength to deal with any uncertainty in financial markets and the wider economy. And you can have confidence that we're going to be there for you in years to come. One of the areas that sets us apart from sort of other financial advice firms is the advisory board, which contains leading members of your profession. They're here to make sure that we're constantly delivering products and services which are relevant and valuable to you at every stage of your career. I'm one of a team of specialist financial advisors that are sort of nationwide, and we specialise and deal with GPs. We've got other advisors who look after hospital doctors and others who look after dentists and teachers. The Wesleyan Foundation was set up to help good causes across the UK, and we invite members and customers to nominate and vote for the causes that they would like us to support. Finally, we cherish our mutual status, and our integral values are rooted in everything we do. So that means we put our members and our customers first, put them at the heart of everything that we do. If we look at how Wesleyan can help, so we can support you with a sort of wide variety of different financial products that will help to support you throughout the different stages of your career. So savings, investments, financial protection, mortgages, retirement and estate planning, and sort of general insurances are there as well. So what we're going to cover today, we're going to focus on two main areas. Firstly, it'll help give you a better understanding of how the NHS pension works. And then we'll look at the options available to access your pension benefits. If at the end, as I say, you've got questions, we'll be able to tackle those. Or you can arrange to have a one-to-one review with either myself or one of my colleagues. Okay, so let's start by looking at the different schemes that the NHS pension sort of is broken down to, and the different schemes you may be a member of. So firstly, we've got the 1995 section. And within this, your pension is based on 1.4% of your uprated pensionable earnings. So each year your earnings are added to a pot, which is then revalued according to inflation. The resulting figure is known as your uprated earnings. And as I say, 1.4% of that figure is then taken to calculate the pension. And then there is a sort of automatic lump sum within there of 3 times the pension amount. The normal pension age for the 95 scheme is age 60. In April 2008, a new scheme was introduced, remarkably called the 2008 section. So this works similar in terms of the uprated earnings, the difference being you now get a pension of 1.87% of the figure, but there is no automatic lump sum that accrues. And normal pension age for the 2008 scheme is age 65. Further changes came in the shape of the 2015 scheme. And the 2015 scheme is effectively a career average revalued earnings scheme for everybody, not just practitioners. And you accrue a pension of 1/54th of your pensionable pay for every year. The normal pension age is aligned with state pension age. So that'll be sort of 66 if you're retiring now, 67, 68, depending on your age. Okay, so when the 2015 scheme was announced, they introduced different category of members. So the first category is the protected members. So this was anybody who had got 10 years or fewer to retirement as at the 1st of April 2012 were known as protected members. And what happened with this category is they didn't join the 2015 scheme. They were allowed to remain a member of their legacy scheme, so either the 95 or the 2008 scheme, right through to retirement. Tapered members. So this category was people who had just got a little bit longer to retire as at the 1st of April. So they'd got somewhere between 10 years and 13 years and 5 months to retirement. And they were effectively allowed to join the 2015 scheme at a later point. So they could remain a member of their legacy scheme for a little bit longer, but not right through to retirement, as the protected members were allowed to do. Okay, transition member is basically everybody else. So if you had got more than 13 years and 5 months to your normal pension age, as at the 1st of April 2012, the plan was you would join the 2015 scheme on the 1st of April 2015. Now, this is where all of the issues around the pension age discrimination came in, because they've effectively produced 3 categories of members of the new scheme based purely on how old they were. So the courts agreed that this was pension age discrimination, hence the McLeod judgment and the McLeod case. So I've got here a flow chart which helps to sort of get you to understand the impact the pension changes the McLeod judgment would have on you. If you've got any specific questions, as I say, you might want to just make a note of them for later. So some members will benefit from moving into the reform scheme rather than moving all of their benefits back to the legacy scheme. And the government is proposing to give members a choice. So the choice is all about the 7-year period from the 1st of April 2015 until the 31st of March 2022, known as the remedy period. And effectively what you're going to be entitled to do is choose which scheme you accumulate benefits in during that period of time. However, you do not need to make that decision until retirement, and that's known as the deferred choice underpin. NHS pensions have decided that the majority of members will probably prefer to have the benefits in their legacy scheme. So are looking to move everybody's accumulation into the legacy scheme for that 7-year period. Hence the reason you're probably having issues getting hold of total reward statements and up-to-date informations around annual allowance, because that work's being done currently. However, you can reverse that decision at retirement. So if you are sort of more attracted to the idea of later retirement, the deferred choice underpin might mean that the reformed scheme is the better option for you, i.e. the 2015 scheme. So that's the 7-year period, 1st of April 15, 31st of March 2022. So what happens from the 1st of April 2022? In effect, everybody joins the new 2015 scheme on the 1st of April 2022. So let's have a closer look at that particular scheme. Okay, so essentially your pension is going to be calculated by taking a set percentage or a fraction, 1/54th, of your pensionable earnings and put into a pension pot. Each year, that pension pot will be increased by indexation, and then you'll have a further 1/54th added for the following year's service. Okay. What are the options for increasing your NHS pension benefit? So you can still buy additional pension in the 2015 scheme, and you can buy up to a maximum of £6,500 a year of pensionable pension income in multiples of £250. You can buy additional voluntary contributions, and the two in-house companies are Standard Life and Prudential. Or you can do something known as the Early Retirement Reduction Buyout, or ERBO, as you might have heard it referred to. And what that allows you to do is reduce the normal retirement age on the scheme from state pension age down to 65. Okay, so that's how the pensions work. And now I'm going to spend a little bit of time talking about tax implications. So starting with the annual allowance. So this is the money that can be paid into your pension each year. And for the 23-24 tax year, the annual allowance was increased to £60,000. Any amount over the annual allowance will be liable to additional income tax, which could be up to 45%, depending on your income, because it's kind of added to your income in the year of the excess, and the right income tax rate will apply. In April 2016, there was a new rule brought in called tapered annual allowance. And it was aimed at sort of the higher income payers, higher income earners. And what would happen with this is you may be subject to a lower annual allowance if you were to exceed the threshold and adjusted incomes. And effectively, you would lose £1 of the annual allowance for every £2 of income that were above £260,000, meaning that if your adjusted income was in excess of £320,000, your annual allowance would see a £50,000 reduction down to £10,000. Okay, so the other tax implication is the lifetime allowance. So the lifetime allowance is the maximum amount you can build up in your pensions over your lifetime without incurring an additional tax charge. Now, the charge itself was removed by the spring budget of 2023. So in April 2023, all of the charges were kind of cancelled, and the allowance itself was abolished altogether in April 2024. However, many clients will sort of still maybe have some protections in place that they've taken on the advice of their accountants, and you can still apply for something called IP16, Individual Protection 2016, if your pension was valued above £1 million in 2016, and that could mean that you could get a higher protected amount at 1.25 million. Why is that important when the lifetime allowance has been abolished? It's kind of covered on the next slide, where we talk about the lump sum allowance and the lump sum death benefit allowance. So, as I say, these were introduced 1st of April 2024 with a view of replacing the lifetime allowance. The lump sum allowance is £268,275, or 25% of any lifetime allowance protection that a member holds, if that figure is higher. And then when you take any tax-free cash from either the NHS pension or any personal pension, that is then tested against that limit. If you take a higher tax-free amount, the excess is then taxed at the individual's highest marginal rate. The lump sum death benefit allowance of actually the figure's wrong there. It should be 1073,100. My apologies. So the lump sum death benefit allowance is 1073,100. So that's for death benefits. If somebody was to die and their family was to receive the lump sum from the NHS pension or personal pensions, and that exceeded £1,073,000, there could also be some income tax implications. Okay, so the NHS pensions, it's a great scheme. It's a great way to save for retirement, but it's not the only way to save for retirement. As this slide shows, there are alternatives. In fact, retirement planning can be done through a number of different assets, and your local specialist financial advisor would be happy to sort of chat you through the sort of validity of any other options you wanted to consider. Okay, so one of the questions I get asked an awful lot is, when should I retire? So if you are a member of the NHS pension scheme, you might want to consider the dates that you can take pension benefits from the scheme. So let's have a look at those. Okay, so 55 is the minimum age. That's the earliest point that you can take money out of either a personal pension or take money from the NHS pension. The normal pension age for the 1995 scheme is age 60. 65 is the normal pension age for the 08 scheme. And state retirement age is the normal pension age for the 2015 scheme. However, don't let those dates be the main driver of your retirement planning. What you should be thinking more about is, what are your objectives? What do you want to do? And kind of looking at what income would I generate? What do I need? What are my expenses going to look like? What sort of, how do I want to spend my time in retirement? Okay, so can I retire early? I suppose that kind of begs sort of a couple of questions, really. Is sort of, when's early and what do you mean by retirement? Are you looking to stop work completely? If so, what will you do with your time? And how will you be able to achieve your financial independence? So if you are stopping work completely and no longer picking up work as either a salaried or sort of partner GP. So one of the areas that we are helping clients with is helping them with these questions really and looking at cash flow modeling to help them get their head round when is the right time. Will I have enough income? Will I be able to do all the things I wanted to plan to do when I retired? Okay, so let's have a look at what the NHS pension benefits will look like if you are looking at early retirement. Okay, so with any pension, if you take the benefits earlier than expected, there's going to be a reduction on the amount of income that you receive because effectively you're going to be receiving it for longer. So taking the benefits just 5 years earlier will reduce the 1995 scheme by 20% reduction in the pension income and an 11.2% reduction in the lump sum. From the '08 scheme, we're going to see a 21.9% reduction in the pension income. And in 15 scheme, that reduction will be 23.1%. Remember, both the '08 and the 15 scheme do not have an automatic lump sum, and therefore that's why their sort of reductions are bigger than the 95 scheme. Okay, so yeah, those reductions can be quite considerable. Okay, so what options are available for you? So since the 1st of April 2023, we effectively got a change to retire and sort of return. So if you're not ready to stop work altogether, you can retire, take your full pension, and then return to work after a short break and rejoin the sort of 2015 scheme. That short break being just 24 hours. So this is known as retire and return. This has always been available in the sort of '08 and the 15 section, and only became available from April 23, as I say, for the 95 scheme. Another option, which was introduced in, oh, apologies, I've gone the wrong way. Another option, which became available in October 2023, is the partial retirement. So with partial retirement, you can claim your pension whilst continuing to work without having to take a break and without having to leave your role. What you do need to do, however, is take a reduction in your pensionable commitment. So if you were to opt for partial retirement, let's say you could take anywhere between 20% and 100% of your 1995 benefits and continue to work, continue to contribute to the 2015 scheme. But for the 12 months after taking the 95 benefits, your pensionable commitment would need to be 10% lower than it was in the 12 months leading up to taking the benefits. Okay. So let's have a closer look at retirement return versus partial retirement. So when are they available? So they're both available from the age of 55. Do you need to be an active member? So you don't need to be an active member of the 95 scheme to take the benefits, but to return, you would obviously rejoin the 2015 scheme. For the partial retirement, you must be an active member. So you must be actively contributing to the scheme to allow you to do partial retirement. Reduction in pay is not required with the retirement return, but most of the clients I speak to do kind of plan to cut down on their commitment once they've taken the pension benefits. And for the partial retirement, yeah, reduction in pay is probable. For officers, they do need to take a 10% reduction in pensionable pay, and for practitioners, there must be a reduction in that pensionable commitment. Okay, so 24-hour break. Yes, retire and return needs to be at least a 24-hour break. There doesn't for partial retirement. As I say, you can just continue in your role. And will abatement apply? So abatement would only apply for retire and return if they retired prior to the normal retirement age, so before the age of 60. And abatement would apply if the pensionable commitment was more than 90% in the 12 months after taking those partial retirement benefits. So that slide just gives you the position sort of pre-April 23 and post-April 2023 for the retire and return. I think we've covered most of that. So prior to April 2023, if somebody was to take their 95 benefits, they could not then continue to contribute to the 2015 scheme. And to access the benefit, they must have had a 24-hour break, and then they had to work no more than 16 hours a week for the first month. What's the position now? So members who take their 95 benefits can return to work, and they can rejoin the 2015 scheme. Even members who have reached maximum service in the 95 scheme can rejoin the 2015 scheme. The 16-hour rule has been permanently removed, and the abatement rules would still apply to mental health officers and special class members, although currently all abatement is suspended until the 31st of March this year. And we are expecting that abatement to be suspended permanently. Retire and return. So partial retirement was not available in the 95 section prior to October 23. You could do it in the 08 and the 15 schemes by taking up to 80% of their benefits. So what's changed since October? Members across all of the schemes can take up to 100% of their pension and continue working. As I said before, there must be a 10% reduction in commitment. Retirement returns available from 55 or 50 if you qualify for that as an early retirement. Partial retirement abatement will apply if the income is more than 90% in the 12 months after taking the benefits. Okay, so who's eligible? So anybody who's reached minimum pension age is active member of the scheme, is reducing their pensionable pay or pensionable commitments, and expect that new level of pensionable commitment to last for at least 12 months. And they've not already claimed to partial retirement on 2 previous occasions. Because as I say, you can take from 20% of the 95 benefits, but you can only do it in two buys, really. What's the position for deferred members of the 95 scheme? So people who are not active members. So they can remain deferred and use retire and return. They could rejoin, and they only have to rejoin for 1 day, and then that would make them eligible for the partial retirement. or they could wait until they'd been deferred for 5 years, and then they could apply for the benefits without having to take any break, without having to do 24-hour retirement. How can we help at Wesleyan? So we've got a service which is the NHS Pension Assessment Service, where we can model various different scenarios for clients. What it includes, it looks at projection of benefits across all of your different schemes to the ages that you want to consider as retirement. If that includes early retirement, we'll build in those actuarial reductions to the figures. We'll look at historic and future annual allowance position. You might want to remain deferred, or you might want to opt in and then opt back out again. We can model those scenarios as well. And we can, of course, look at partial retirement, where you take all of the 95 benefits and then rejoin 15. And all of the reports will include the McLeod decision. So we'll give you the figures based on both the pre-McLeod and the post-McLeod scenario, which might help you with when it comes to the deferred choice underpin. Another service we are fairly proud of is our retirement club. So it's a new service. It's aimed at helping medical professionals plan for their ideal retirement. It's sort of designated sort of hub on the website, which gives lots and lots of information for people who are sort of approaching retirement, at retirement age. So what do I do? And those who are in retirement already. The key benefits of the club allows you to work with specialist financial advisors to identify the key retirement objectives. And as I say, one of the tools we use there is sort of cash flow modeling, that allows you to sort of understand the financial implications of retirement. Okay, so hopefully you know a little bit more about the NHS pension than you did prior, and a little bit more about the McLeod judgment. So why is it important to get guidance? So it's important to have a plan, put a plan in action now for your retirement. It's important to understand the impact of the changes on your pension. Think about ways to boost that pension if need be. If you know you've looked at the cash flow or looked at the figures and kind of think could do with a little bit more than that. Review your existing savings and investments. Are they in line with what you want to achieve? Are the death benefits and family benefits, are they in line with what's expected? And then it's important to review your arrangements on a sort of fairly regular basis. So next steps, we would recommend, if you've got any kind of sort of personal objectives, personal scenarios that you want to talk through, make an appointment with either myself or one of my colleagues. The initial discussion is totally free of charge. We'll discuss your unique needs, receive specialist guidance, and let us help you to make the most of your pension benefits and associated finances. Any questions? So the QR code is, and I'll put something in the link in the chat as well, with a link for a form. If you do want to have a meeting with either one of our specialist financial advisors, you can use that QR code, key your details. One of my colleagues will give you a call and book you into diaries for that initial discussion. Any questions?
Thanks, Kevin. That's really helpful. Got a couple of questions in the chat, actually. So
Okay.
probably
Yeah.
sort of the quickest one to answer might be Neil's, asking, can you explain what you mean by abatement?
Yeah, so abatement is when they would stop paying the pension. So the only time it's going to apply at the moment is probably the partial retirement. So one of the rules of partial retirement is you need to take that 90% reduction in either pensionable pay for hospital doctors, office people within the officer scheme, or for GPs, a 10% reduction in your pensionable commitment. If that didn't happen, NHS pensions could stop paying the pension until you revert back to the 90% reduction. So that's what we mean by abatement. It's kind of they're holding back the pension until you play by their rules.
Great, thank you.
Was that, so that was Neil's question?
Yeah, I'm just wondering actually if you want to stop sharing just for a moment, Kevin.
I was just leaving that QR code on there for as long as I could, but yeah,
oh, okay, got you
now. Oh, let me just stop sharing. There we go.
Yeah, thank you.
Hi, Neil.
I was just trying to get in my head. Abatement's different from actuarial reduction.
Actuarial reduction is a permanent reduction for taking the pension early.
Yeah, so that's different from abatement.
It is. Abatement is, as I say, you just need to play by their rules and take that, reduce your pay after taking your benefits.
Yeah, thanks. And then if you do retire and return, the other question I have was, can you go back to the same role?
Yes.
Oh, yeah. Okay.
Yes, you can. So, but you do need to resign from the role. So if that's resigning from a partnership or resigning from a salaried role, you do need to have physically left that role for at least 24 hours. So that could be, I finished on Friday, I'm going to start again on Monday. So it could be a short period of that.
You have to be certain they want you back.
Yeah, exactly. Don't do it without there being some kind of written guarantee that you're going to get that role back on the same terms. Because I've heard some horror stories where sick pay has been changed and holiday entitlement's been changed because their service has sort of only been 1 day rather than the 20 years they did beforehand.
Thank you.
David.
Right.
David, come on in.
Yeah, hi. Yeah, just one was a jokey question which I put on the chat about can you, if you retire, can you stop doing tax returns? Is it to do with your income threshold? So if your income drops below a certain amount, is that why you always have to do tax returns for many years after retiring?
You don't always have to do, because if all of your income's PAYE,
Yes.
so if your sole income was the NHS pension income,
Yes, you can stop.
There would be no need for you to do self-assessment tax returns.
Okay. This one, just let me qualify this. I am in discussion with one of your colleagues, Keith Johnson. So I haven't engaged with Pete. But if it's too general or not appropriate, I'll just say speak to Keith, please, and stop me. So my situation is a little different in that I technically retired at 55 because I bought added years. My accountants kept on going on about my lifetime allowance going to breach. But now my circumstances have changed. I'm in my early 60s now. And I'm going to do GP retention for a year or two. So I don't know. I was on the 95 scheme, so I don't know. I haven't. There's been a big gap, about 7 years. Can you go back in after such a big gap? And is there any rules about it, or do you want to speak to?
But you won't be able to go back into the 95 scheme.
You can't do that because it's closed.
You'll be able to go into the 2015 scheme.
Yes.
And the only link, I suppose, to the lifetime allowance now is the lump sum allowance. So what is they would look at when you took those benefits at 55.
Yeah.
What percentage of the lifetime allowance did you use at that point?
Got you.
And say if you use 80% of your lifetime allowance at that point, that would mean you would, in simple terms, you could have a 20% lump sum allowance remaining. So you could have 200,000 still available as a tax-free lump sum.
So you could still go back into the NHS pension, but there's some calculations to be done. That's what you're saying.
Yeah, there'll be calculations to be done when you access the 2015 scheme. So if you rejoined it for a few years and then you get benefits from that scheme, there would be a limit on how much tax-free cash you could opt to take from the scheme.
Okay, thank you very much. I'll leave it at that. Thank you.
I won't tread on Keith's toes.
No, I did say that's why I wanted to declare that. Thank you.
So,
thank you. There's a question in the chat, Kevin, from Julie, asking, can you defer taking the retirement benefit if retiring early? And does this mean the reduction in benefit is less?
Yeah, so if you're retiring early and you're not in a position, you don't need to take the benefits, you can just become a deferred member of the scheme and then apply for the benefits when you want to, so every year closer to normal retirement age will probably add about 4% back into the plan, because you lose around about 4% a year for retiring on that 95 reduction. It was 20%, wasn't it? It was 20% reduction for taking it 5 years early. So in simple terms, it's about 4% a year.
So that's great. Thanks. Just even though you're not obviously paying in once if you've finished but don't take it.
Yeah, absolutely. So yeah, so if you, I don't know, for argument's sake, you finished at 55, decided to stop working, didn't need to take the NHS pension benefits, you just become a deferred member. So you're not putting any more money into the scheme. You then might decide at 58 to take the benefits, and that reduction would be about 8% rather than it being 20% if you took it at 55.
Okay, that's great. Thanks for explaining. Thanks.
No problem.
And just following on for that, this might be a very basic question, but so presuming if you're in the 95 scheme and the 2015 scheme, you could take your 95 scheme, but then presume the 2015 scheme you can't take till later. Normally that would be normal pension age.
No, so both schemes are available from the age of 55. So you can access them both from that minimum pension age of 55. However, if you're taking the 15 scheme at 55, you're effectively taking that 12 years early rather than 5. So the reduction would be quite substantial.
Thank you. Vicky, you've got a question there. Did you want to ask it yourself?
Yeah, so it's just, I guess it's a bit particular to me in my age, but I want to retire in 3 years' time, at which point I will be 56. My birthday's in March. But I'd heard a rumour that the minimum age you can take it's going to jump from 55 to 57. And I'm a bit worried that I'm going to suddenly discover that I can't actually take my pension for another year. Is this right?
It is going to jump, but not until 2028.
But that's when I'm planning to.
Okay.
That's it. And that's when I'll be 56. Just in March 2028, I turn 56.
Right. So you might be okay, because I think it's from 1st of April 2028.
But if I was to retire at 1st of April, because you often like to at the end of a financial year, for sake, do I run a danger that they'll not quite get it in there in time? Do I have to retire a few weeks earlier? How reliable are these guys?
So yeah, I mean, you could, because you don't have to retire on a birthday. You could effectively just go, right, I'm going to retire. I'm going to take my benefits when I'm 55 and 11 months. So you can choose the date to avoid that minimum age going up to 57.
Okay. And once you fix that date, it doesn't matter if they're slow processing things. That's their problem, not mine.
Oh yeah, absolutely. Yeah. If I mean, they say give them 3 months to process the application. It's more like 4 in practice, but they backdate the retirement age to the date you put on the form. So you'll just get backdated pension income from that point.
That's brilliant. Thank you.
No problem.
I've got a question, if you don't mind, Kevin. And I don't know whether you can answer this. Is what kind of GPs are likely to be the ones to benefit from moving to the 2015 scheme as opposed to staying in the legacy?
So, so clearly everybody's now anybody who's an active member are now actively contributing to the 2015 scheme.
Mm-hmm.
So are you referring to the deferred choice underpin?
Yeah.
So why would somebody choose to have the 7 years in the remedy period in the 15 scheme? So i.e. the period 1st of April 15 to 31st of March 2022. If you are planning to take your pension benefits, I would suggest before the age of 63, so up to the age of 63, if you're planning to take the pension benefits of that, it would be in your interest to have that remedy period in the 95 scheme or the 08 scheme. If, however, you're thinking, I'm more likely I love my job, there's no stress involved in it at all, so I'm more likely to continue to work until I'm 65, 66, 67, and I won't need my pension until then. That's likely that the remedy period, you're better off in the reformed scheme, the 15 scheme. But as I say, you will get that choice. NHS pensions should present you with almost like a decision tree and say, right, okay, do you want this one or this one?
And that's where you need somebody to do your projections for you, isn't it, then, too?
And I know a company that do that really well. Yeah.
Might it be Wesleyan?
It could well be Wesleyan, yeah.
It could be.
Could well be Wesleyan.
Thank you. Anybody got any questions? Anything else that's not in the chat? I know Neil's put a comment and I will come to that, Neil. Jane.
So, Kevin, can you just remind me about the McLeod judgment? And am I right in thinking if you were affected by that, they will automatically contact you?
So yeah, so in terms of the McLeod, if so which bit of the remind you about the McLeod did you want me to cover off?
Well, it's difficult, isn't it? Yeah. So what I'm saying is you don't need to proactively do anything.
So if you've taken
That's
your pension benefits already,
yes,
yeah.
That's what I mean.
So if you've taken those benefits already and you were in the 15 scheme for part of that remedy period, NHS pensions will get in touch with you because they probably owe you some money.
But you had to be in the 15 scheme. What happens if you're in the legacy schemes?
So were you in the legacy scheme all the way through?
All the way through.
Okay, so you're not impacted by the McLeod case at all.
At all.
No, because you would have remained in that in your legacy scheme right through to taking your benefits.
Okay, so it's of no relevance whatsoever.
And no relevance to you whatsoever.
That's not what I was informed about before, not by you, but oh, that's interesting. Okay, thank you.
Okay.
Okay, that's fine.
Thank you. Neil is just reminding everybody to check your contribution history, and I've got a few slides just to remind you about this. Absolutely essential. Even with what you consider to be a straightforward career, sometimes years and contributions are missing, and it's much better to do that sooner rather than later. I'm going to take you through the PCSE sort of suggested timeline, okay, which is sort of 6 to 12 months in advance of when you think you want to retire. But quite honestly, I would start thinking about looking about it now, because it's sometimes taking people many months to uncover what's happened to their lost contributions. So thank you for raising that, Neil.
Took me years. Took me nearly 4 years to recover it.
It's a ploy to keep you working, I think, Neil.
And it was incredible because in the end, the BMS had put a subject access request into the tax office, and the tax office said, "Well, you've not paid any tax for the last 15 years, so I don't exist." So explain that one. despite the fact that I paid national insurance. And still to this day, I don't know where my contributions went. They've never admitted they made a mistake, but they've actually recompensed it. So obviously they did make a mistake. I suspect someone has got a very good pension based on my contributions.
So, learning point or action point from tonight: check with PCSE that they've got all your pension contribution years. Yeah. And Margaret,
particularly if you've done a portfolio role, if you've done more than one role, because the number of errors of people doing more than one role, where they're anticipating information coming in for a role that you've probably stopped, and what happens is they don't process any of the information they do get until they're still waiting for this info that's not going to ever arrive.
Yeah, I've been at the same practice for 25 years with the same practice manager, and I still managed to lose it.
Yeah.
Sounds like Diane's had a similar issue as well when PCSE took over. And Margaret's got a good question here, actually, asking about the pension. Is it better to retire at the end of the month or the beginning of the month?
I don't think there's any real difference, to be honest.
So
I think it's worth asking the accountants, isn't it?
Yeah, shall I explain why I've put that up?
Yes.
Because I retired on the end of the month, and I was later told that if I had retired on the 1st of the month, so I retired on the 30th of March and got my pension then, and they said if I'd retired on the 1st of April, you'd have got an extra month's accrual of your pension benefit. So that's what I was told. And one day made a difference.
Was that a normal retirement age, Margaret, or was that an
An early retirement age?
Oh, right. Okay. Sorry. Yes.
I retired at 59 and 6 months, but I took 24-hour retirement and then I went back to work. So I believe that is...
Yeah, so the actuarial reduction is done on a month by month basis. So although we've been talking in terms of like 5 years and a 20% reduction, it is kind of tiered for every month. So yeah.
Yeah. So I just want other people to learn from my mistake. So
yeah.
Thanks, Margaret. Any other questions? Any other thing you want to ask Kevin?
Okay. If I'm no longer needed, I'm going to go and watch Manchester United get beat again. So
well, good luck with that. Thank you, Kevin. Thanks for joining us. And please, everybody, do have a look at thinking about getting a one-to-one assessment. It's free, and if you wish to, Kevin or one of his colleagues would be very happy to talk about finance and pensions as well.
Yeah. And as I say, there's a link right at the start of the chat. So if I know the QR code's not on the screen anymore, but there's still a link in the chat.
We could send the QR code actually round through with the slides, actually, Kevin, if you're happy with that.
Yeah, sure. Yeah, absolutely.
We'll do that too. Yeah, brilliant. Thanks so much for joining us, Kevin. And I'd just like to take the opportunity now just to ask some of our RCGP members here if they've got any other handy hints and tips that they'd like to share. So, Margaret, you started off with that very useful one. Anything else you want to add?
Yeah, so the first thing to say is that I did ask my accountants for their advice, and I think some accountants are better than others. So you can ask their advice, but you don't always get the correct advice. So I think that's where maybe the fact that Wesleyan are doing this checking service, if this was available now, I would definitely be taking up that offer, because I think that Wesleyan do really have a good understanding of GP pensions. So some accountancy firms, they don't necessarily know huge amounts about the pension scheme, because at the end of the day, they're accountants. Secondly, if you are a GP partner, it's worth you knowing that your pension, because the accounts are very rarely finished when you actually retire. So you're going to get an accounting period, the following year. So you may end up getting an uprated pension, which is obviously a good thing, but then there's often an extra lump sum, and there are tax implications from all of that. So just to be aware of that. The good news is if you're salaried, you don't get into that problem. And then the only other general things were to do with, you know, the fact that you, your practice manager isn't probably involved in people retiring that often. And so they often need sort of help and support to sort of organise all the organisational aspects of retiring, you know, such as CQC, etc. But you've got a very helpful chart now of who to let know when you are retiring, which wasn't really, I don't think, readily available when I retired. And then obviously there are the normal things about, which we've talked about in previous meetings, about thinking about your own practice roles and patient handovers of complex patients, especially terminally ill patients, and then the areas around your own personal preparation for retiring, because it's, you know, I know there are people on the meeting tonight who intend to retire early, but just to share with you, I retired at the age of 61 and I was only away from it for 3 months. I went back to work. I was just so bored. So there's lots of other things you can do on a part-time basis, which actually, you know, you can often have like a second career, and it's fantastic, actually, to do that. So just to be aware of that you may want to do something post the practice retirement.
That's a really good point, actually, now to plug our next session, Margaret, because the session on the 19th of March is to talk about exactly that, to give you options around late career, about extending your career. And we'll have several GPs talking from the local workforce schemes, from the RCGP, but also retained GP scheme, research in general practice, volunteering in the UK and abroad, working for the clinical design authority. So lots and lots of options that you might want to do towards the late career. And one really important point is now you can actually work as a GP in a restricted role with the agreement of your practice, okay, without there being any consequence, okay, and it's an unlimited time period. So if you happen to just want to fit coils and implants or do dermatology in general practice, that is now permissible through NHS England. So lots more scope to reduce your scope of practice if you want. Thank you, Margaret. That's really helpful. Jane, did you have any other handy hints or tips?
Only really just to concur exactly with what Margaret said, that you know, I've retired and I went to my accountants for advice, but they didn't give me the best advice, I don't think, even though they're supposed to be specialists in the field, but hey. So actually, likewise, I would, if I had my time again, I would go to Wesleyan for some advice. So it's a shame Kevin's gone because I'm plugging his service, but I think it's a good thing to do. Yes, and it's a shame, well, it's fabulous now that there is a scope for GPs working in a restricted role. I think this is absolutely fantastic, and a good opportunity for people to do when they're thinking about coming to the end of their career or retirement. And I would like to encourage people to engage with the Royal College of GPs, because we're trying to also develop a support package for people who are in transitioning in their careers, from either mid-career or late careers, or even into retirement, to get some peer support and some small groups going, and some ideas about what people can do in their later careers. So watch this space, and more next time.
Brilliant. Thank you, Jane. Marilyn, have you got anything to add?
Only to say the same thing, really, to get specialist advice. I think it's really important. The other thing is a tax thing, really, is that you are liable for tax even after you've retired if there's issues with your practice and they find some liabilities whilst you were working. Do you see what I mean? You're still actually technically liable. It depends a bit on your practice as to whether they would liable for debts, is what I'm saying, well, not tax really. That's a different issue. So if they find that they've overpaid you when you were working, for instance, or somebody claims back stuff, then you are technically still liable for that. Varies between practices as to whether they enforce that, but it's just something to be aware of.
And I have actually heard on that note, Marilyn, that some practices do hold back money, don't they, in drawings for partners. So this relating to partners, not salary GPs, obviously, but for partnerships, they may hold back some money in order to be able to cover those sort of extra costs. And equally, you know, if they're not required to pay that, then you may get money back later on. But it can be a year or two afterwards because of the, you know, accounts not being finalised in time.
Yeah.
Thank you. Martin, you've got your hand raised. Would you like to come on in?
Yeah, just one point that came up for me. When you decide that you want to come off the register when you retire, coming off the performers list was very straightforward. But coming off the register was actually remarkably difficult, because I've had, you know, several sort of ancillary roles over the years, and you need these letters of good standing from people. And depending on where you've worked, some organisations have disappeared into the ether, and finding the right person to write a letter to say that you're in good standing. And surprisingly for me, the thing that caused me a problem was doing appraisals. Finding somebody at NHS England who would, because there were so many reorganisations in the meantime, was actually quite an issue, and it went on for months to get to come off the register. I mean, it just didn't seem to make any sense. But so if you have had lots of roles, it is worth just keeping a track of who you would approach for those letters.
Thank you. That's really helpful. Any other questions?
Can I just say it might be easy to come off the performers list, but it's very hard to get back on. So I know we've said this every time, but just in case there's anybody new on, don't come off the performers list until you're absolutely sure that that's the right thing to do, because it's so hard to get back on.
Yeah, I know they made it a bit easier for COVID, didn't they? But I'm not quite sure what the situation is now. Okay, that's been really helpful. Thank you. I'm just going to show you what the PCSE sort of booklet looks like for those of you who are actually going to be thinking about retiring anytime soon, and before we end the call. So just bear with me while I share my screen. So hopefully you can see that. So if you are actually in the process of wanting to retire, okay, you need to look at the PCSE literature, and it looks a bit like this. Okay, this is the NHS Pension Scheme Retirement Guide. Okay, it has a nice handy contents page. It tells you what you need to do. It tells you all about partial retirement, retire and return, and it tells you about the 6-step retirement process. So I'm just going to show you what those pages look like. Okay, it also gives you a time scale, okay, of when it suggests that you do these things. But actually, certainly following what Neil has said and what I've heard from other people, I very much suggest that you start looking at this way in advance, okay, of what actually PCSE says. So really, the really important things are looking that your pension record is up to date and correct, okay, and you need to be starting to think about doing that now, because there are horror stories of lost years as well. Step 1 is all about agreeing your retirement date and who you need to agree with. If you're a partner, okay, whether it's GMS or PMS, you need to be getting approval from the ICB. But if you're salaried, it's simply the practice. Again, this is probably the biggest learning point, is making sure your pensions record is up to date with PCSE online, and challenge anything that you feel is incorrect. Step 3 is all about completing the AW8 form, okay, and this goes off to PCSE. Step 4, okay, is talking about retiring from the performers list that we've just talked about. Step 5 is that PCSE will process your AW8, and they say that they will do that normally within about 3 months, but we're hearing that it takes longer than that. So again, get it in as early as you possibly can. And then NHS pensions will calculate your pension. Again, there is a bit of a lag with getting projections from the total reward statements. So really important to try and get somebody to help you with that, potentially Wesleyan or other people in mind. And then just finally, some more top tips from another GP who couldn't join us. And she actually has also suggested taking some advice from Wesleyan. She said their integral financial planning support has been invaluable and is of ongoing support even since her policy has ceased. She suggests that you make full use of anything like that you may be entitled to. And don't forget that sometimes banks and accountants will offer a similar kind of service to you coming up to retirement. She is suggesting that you request your total rewards statement at least a year before you plan to retire. So it gives you some figures to work out whether you actually can afford to retire and what your predicted lump sum and annual amount will be. And equally, whether you want to then move to stay on your legacy scheme or whether you move to the 2015 scheme if you're in that situation. Again, somebody else saying make sure that your PCSE records are up to date. And she's also suggested that you consider investing your tax-free lump sum, okay, and if interest rates are high, that you might actually get a good sort of interest rates to get money that can be built up in sort of tax-free things like ISAs and premium bonds. She makes quite an important valid point about if you're a property owner, if you have a share in the building, for instance, be clear that there is a plan to release your equity and you're not potentially the last man standing. I'm thinking about the timing again, can be timed to fit with birthdays, and the accountant didn't need to do any extra counts, but it is worth just thinking about if you're retiring early, as Kevin said, that might affect the amount that you get. So we've come to the end of the evening, so just want to say there is another QR code there, which feel free to, whoops, I'm going to...
Can I just say something?
Yes, please do.
Yeah. So for anybody that's single, because I'm divorced, I would urge you to always take your maximum lump-free sum because your pension dies with you. So if you don't take your maximum lump-free tax-free sum and then you die, then obviously that money is not in your estate. So I definitely took the maximum amount because my pension dies with me.
I would concur with that.
Yeah. So, but obviously, if you are married and your pension is going to go to your partner, that's absolutely fine. But if you're, as I say, it's somebody like me divorced, then it dies with me.
Thank you. That's helpful, Neil.
Right, can I just ask a question to do with tax liability? Not from the pension, but when you actually leave the practice. In general, how long does that tax liability go, or is it a case of you just have to ask your accountant to do a projection? It's just I can remember when our previous partners retired, they appeared in the tax in our tax meetings, our business meetings at the end of the year for probably 2 to 3 years. Do you need to plan for that, or is it really just a case of every practice is different and you need to ask your accountant to just project to see whether you will have sort of liability going forward?
Well, it depends whether you leave your tax in the accounts or you take your tax out of the accounts. So our tax was always provided for and left in the accounts, and it took 2 sets of accounts to get me out of the practice. So it's 2 years.
2 years, yeah.
Yeah, it took me about 2 years to get my final payout and all the tax sorted out, etc. Probably a good 2 years. Yeah.
It's variable, basically. But yeah, an average 2 to 3 years.
But it probably is better to get your own accountant to give you some sort of projection, presumably.
Yeah.
Yeah. Thanks. Yeah.
Thank you. Any final thoughts or reflections?
One point, Claire, is I know we all quite like Wesleyan, but there are, I suppose it's that disclaimer that there are other people around Chase de Vere who I think still have an association with the BMA. I've had a good experience with, and these people want your business long term, so all the initial stuff is free. So although you end up feeling like you can recite it, you don't always understand it the first time round. So it's probably worth having a few extra shredded wheat one day and talking to a few people. And I think, you know, the thing that we can't stress enough is make sure the NHS pension record is correct. If you've been in a practice, say like I was, where you looked after one of the community hospitals, there are things there, and sometimes it's coded, so it can be a bit of detective work to work out, depending on how that money's been allocated within your practice, and whether there are weird and wonderful NHSP codes on it. So it's worth a bit of digging. And the thing about, you know, you might want to think about having a separate bank account, like on that last slide, for your lump sum. And yeah, I'd endorse the thing, expect 2 or 3 years of calls on the practice, really. We had an experience where a couple of years after a partner retired, we had to go back and ask for £2,000 or £3,000 because things had changed, and it's not the fault of your practice manager or your partners or your accountants. Generally, it's just, as we all know, things are up and down and late things coming in, and it's just another wonder of the NHS, isn't it?
Thank you, that's really helpful. Good. Well, thank you everybody for joining us tonight. Really good to have you here, and I hope those people who knew nothing or very little about the MacLeod judgment now feel like they know something about it. I have put into the chat our feedback form link, so if you wouldn't mind taking a couple of minutes just to feed back to us and let us know what else you might need with that. And just a reminder, as I say, for the 19th of March is our final session where we'll be talking about potential other roles. So thank you all so much for contributing. I'm sure you won't mind leaving a little bit early this evening. Get on with the rest of your evening. So thanks again for coming, everybody.
Thank you.
Yeah, thanks very much. Thank you. Bye.
Good night.
Claire, I think if she's not already done so, Gillian Davison might just email you asking how to access the recordings, but I've pointed in the direction of Amy at Hub Plus, so you might not get bothered. Yeah. Okay.
Yeah, no, that's fine. I'll share that with Amy and we'll get that posted as well. Lovely.
You.
Good.
Have a lovely holiday.
Oh, thanks, Marilyn. I'll try and come back in one piece. Good. See you all next time, hopefully. Enjoy the rest of your evening. Thank you. Bye. Bye-bye.